FTX crypto meltdown and investor liquidity. This is Ken Boyd. So we've all asked the question when buying products and services, if I buy that sweater from Nordstrom's, what's the return policy? Will my airline allow me to change the travel dates for that vacation without penalty? And how long do I have to return that kitchen appliance for a full refund? We've all asked these questions when it comes to spending. Now let's talk about investing. There's a lot you have to manage as an investor: market risk, investment costs, and retirement. But what we found out with the FTX crash is that one of the biggest issues for investors is liquidity. This discussion defines liquidity and provides examples of liquidity for various investments. This post also explains what happened at FTX, the huge crypto firm, and how a lack of liquidity caused investor losses. So let's talk about what is liquidity. For finance, liquidity is the ability to sell an asset quickly and also at a reasonable cost. So let's apply that to the stock market, which you may already know about and be a little more familiar with. What is liquidity in stocks? It's a good starting point because many people own stocks. Assume that somebody buys 100 shares of IBM common stock on the New York Stock Exchange. Market makers, firms that provide a buy and a sell price for IBM, they ensure that there will be a market to sell the stock down the road. Now, you may not like the price that you get for your sale, your bid price. In fact, you may have to take a loss, but exchanges make a market for selling securities. So you can always get a sale price. You can sell your stock on any day the exchange is open, and you can settle your trade and get your funds in just a day or two. You'll pay a commission for each trade. Stock trading commissions in recent years have declined rapidly, and in some cases, you can sell a stock commission-free. The NASDAQ, which you may also be familiar with, is another large exchange for stock trading. In addition to stocks, commodities, precious metals, and other assets also trade on the markets for the same reason. You can sell, you can always find a seller, you can get your money quickly. So why is liquidity important? Because investors eventually need to get the assets they own, either to fund another purchase like a home or to fund their retirement. So we all need liquidity. We all need to get access to the assets eventually. Now, there are consumer protections in financial services. Firms must meet certain requirements to operate, including regulations around holding customer assets. So, for example, if you have cash and securities invested through a firm, they're required to report the holdings to you. That's why you get monthly statements. Many investments, including initial public offerings, are sold by prospectus, a document that provides extensive detail on the company issuing the stock. Prospectus includes audited financial statements by a third-party CPA firm and a lengthy explanation as to why the company is raising funds by selling stock. They give you the why. Importantly for this discussion, custody of investor assets. Many advisors are now categorized as fiduciaries, meaning a person put in a position of trust. They have more responsibility and more liability if they don't follow the rules. Financial service companies can't lend your securities to another party without your approval. Firms must also have an audit performed. The audit confirms that each customer's securities are held in custody on your behalf, which brings us to FTX and the crypto market disruption. So the Wall Street Journal article explains what happened to FTX, which is a large cryptocurrency trading firm. Crypto exchange FTX lent billions of dollars worth of customer assets to fund risky bets by its affiliated trading firm, Alameda Research, setting the stage for the implosion. So FTX lent customer deposits, about $10 billion worth, to a related company, and I have in bold, using money that customers had deposited on the exchange for trading purposes. So what's the lesson here? FTX did not have to follow the same regulations as other financial service companies. Investors don't have liquidity if the assets are no longer held for them. Very important. FTX linked customer assets. They lost the money, and now they filed for bankruptcy, and the investors whose assets were used have to go through the bankruptcy process to try to recover their assets. So the lesson, Crypto investors do not have the regulatory requirements that protect investor assets, and that buyers should beware when it comes to crypto. For more information on accounting and finance, videos, and blog posts, you can go to conferenceroom.com here.